Let's take a look at Dixon Technologies, India, Limited, one of the leading electronic manufacturing service providers in India. Company has exceeded expectations in its September 2024 quarterly results. While analysts projected a revenue of 9,141 crore rupees, the actual figure came in at 11,534 crore rupees, representing a 133% year-on-year growth. EBITDA was also higher than anticipated, at 420 crore rupees, up 110% year-on-year, compared to the expected 350 crore rupees. Net profit surged 263% to 412 crore rupees, far exceeding the estimated 205 crore rupees. With such stellar performance, Dixon continues to solidify its position in the electronics manufacturing sector. Incorporated in 1993, Dixon specializes in consumer electronics, lighting, home appliances, and mobile phones. The company has a market capitalization of 92,039 crores rupees, with a current stock price of 15,382 rupees. Dixon's PE ratio stands at a high 213, reflecting its strong market position, and it has a solid ROE of 29.2%. While Dixon has low dividend yields, its market leadership in LED TVS and electronics drives growth. Let's take a closer look at Dixon Technologies' current price-to-earnings (PE) ratio compared to its historical average. Currently, Dixon's PE stands at an elevated 213, far surpassing its historical median of 115.6. This indicates that the market has high expectations for future earnings growth, but also suggests the stock is trading at a premium. Over the past 5 years, Dixon's PE ratio has seen significant fluctuations, reflecting changing investor sentiment. The current valuation raises the question of whether growth will justify this premium going forward. Dixon Technologies has posted impressive growth in both sales and profits over the last 5 years. Sales have grown from 2,984 crore rupees in FY19 to 20,999 crore rupees in FY24, reflecting a compounded growth rate of 43%. Similarly, net profit surged from 63 crore rupees to 447 crore rupees in the same period, with a compounded profit growth of 42%. Despite strong growth, the company's operating margins have remained stable at around 4 to 5%. This consistent performance highlights Dixon's strong execution in the electronics manufacturing sector. Dixon Technologies has seen a stellar rally, currently trading at 15,334 rupees, reflecting the company's strong performance in recent years. The stock's upward trajectory has been fueled by the Indian government's push for domestic electronics manufacturing under the Make in India initiative. This policy support has boosted Dixon's growth, especially in segments like consumer electronics and LED TVS. However, with the stock trading near its all-time high, it is not available at a discount. Investors should consider waiting for a better entry point. ITC's Q2 FY25 results were slightly below expectations. While analysts projected a net profit of 5,154 crore rupees, the actual figure came in at 5,078 crore rupees, reflecting a 3% year-on-year rise. Revenue, however, was strong, growing 17% to 19,328 crore rupees, against the expectation of 18,068 crores. The company faced rising costs, with expenses up 21%, which impacted profitability slightly. Despite the minor shortfall in net profit, ITC's robust revenue growth shows solid demand across its key business segments. Established in 1910, ITC operates across multiple segments, including FMCG, hotels, paperboards, and agribusiness. With a market cap of 6,08,745 crores rupees, the stock currently trades at 487 rupees. The company's PE ratio is 29.8, ROE stands at 37.5%, and it offers a dividend yield of 2.83%. ITC's strong return metrics and diversified business portfolio make it a prominent player in the Indian market. Let's discuss ITC's current price-to-earnings (PE) ratio compared to its historical trends. As of now, ITC's PE ratio stands around 30, which is significantly above its historical median of 21.8. This increase reflects growing investor confidence and potentially higher future earnings expectations. Over the past 5 years, we've seen fluctuations, with a dip in early 2020 followed by a steady rise. The company's current valuation suggests optimism around its performance, but it's important to evaluate if earnings growth can justify this premium. While ITC Ltd has shown steady growth, with sales increasing from 48,340 crore rupees in FY19 to 72,174 crore rupees in FY24 and a 10% compounded profit growth, its growth rate is relatively moderate. With a sales CAGR of 8% over 5 years, ITC's expansion has been consistent but not high compared to other firms in the FMCG and diversified sectors. Several competitors are demonstrating significantly higher growth rates, driven by more aggressive market strategies and rapid expansion into new product lines and geographies. Looking at ITC's technicals, the stock has seen a significant upward movement over the past 2 years, reaching a peak of 529 rupees recently. However, after a sharp rally, the stock has slightly corrected and is now trading at 477 rupees and 35 paise. While it's still holding strong above key support levels around 402 rupees, it's important to note that the stock is not currently available at a substantial discount compared to its recent high. Investors might want to wait for a more favorable entry point or watch for further price action. Home First Finance reported solid Q2 FY25 results, with net profit increasing by 24.1% year-on-year to 92.2 crore rupees, just below the expected 93 crore rupees. The company's total income rose by 34.6% to 374 crore rupees, driven by strong growth in its core affordable housing segment. While net profit came in slightly lower than expected, the overall income growth highlights the company's ability to capitalize on the rising demand for affordable housing finance, continuing its positive momentum in the sector. Home First Finance Company, HFFC, is a housing finance firm focused on providing affordable home loans with quick 48-hour sanctions and a hassle-free process. With a market capitalization of 10,442 crores rupees, the stock is trading at 1,171 rupees, reflecting a PE ratio of 32.2. The company has a return on equity, ROE, of 15.5% and a return on capital employed, ROCE, of 11.2%. Home First primarily serves first-time homebuyers in the low and middle-income segments, making it a key player in India's affordable housing sector. Let's take a look at Home First Finance's current price-to-earnings, PE, ratio compared to its historical average. The company's current PE stands at around 32, which is in line with its historical median of 32.9 over the past few years. While the PE has fluctuated, it has mostly hovered around this average, suggesting that the market's valuation of the stock remains relatively consistent. However, investors should assess whether future earnings growth justifies maintaining this valuation or if there is potential for re-rating. Home First Finance has demonstrated impressive growth in both sales and profits over the last 5 years. Revenues have grown from 264 crore rupees in FY19 to 1,219 crore rupees TTM, showing a compounded growth rate of 34%. Net profit surged from 25 crore rupees to 324 crore rupees over the same period, reflecting a strong profit growth rate of 46%. This growth has been consistent, with financing margins improving and profitability steadily increasing, indicating the company's ability to scale its housing finance operations effectively. Looking at the technicals of Home First Finance, the stock is currently trading around 1,109 rupees, close to its trendline support. Over the past year, the stock has shown a strong uptrend, with higher highs and higher lows. The stock recently faced resistance near 1,400 rupees and is now consolidating. With the price nearing its trendline support, investors may want to watch for any bullish reversal patterns for potential entry points. However, A breakdown below this support could signal further downside in the short term.